Topic examines directional strategies and methods used within alternative investments. Directional strategies attempt to profit from anticipated movements in asset prices, interest rates, currencies, or commodities. Unlike market-neutral strategies, directional approaches intentionally maintain exposure to market trends and macroeconomic conditions. The program emphasizes that these strategies are based on the idea that financial markets are efficiently inefficient, meaning markets are generally competitive but still contain temporary pricing distortions and behavioral-driven opportunities. Directional investors seek to identify and exploit these inefficiencies through technical analysis, fundamental analysis, macroeconomic forecasting, and behavioral finance insights. Successful implementation requires disciplined risk management, timing skill, and adaptability to evolving market environments. A central concept in the topic is the idea of efficiently inefficient markets. The program explains that markets are sufficiently competitive to prevent easy and persistent excess profits, yet not perfectly efficient because information processing, investor behavior, and institutional constraints create temporary mispricings. Market inefficiencies may arise from behavioral biases, liquidity shortages, regulatory restrictions, or information asymmetry. Alternative investment managers attempt to exploit these opportunities before competition eliminates them. The topic also notes that inefficiencies tend to decline as awareness and capital participation increase, reducing available alpha opportunities over time. Consequently, directional strategies require continuous innovation, superior research, and effective execution to maintain profitability in increasingly sophisticated and competitive global financial markets. The program next explores technical directional strategies, which rely on historical price patterns, trading volume, momentum indicators, and trend analysis rather than fundamental valuation models. Technical analysts believe market prices reflect collective investor psychology and that identifiable patterns can provide signals regarding future price movements. Common approaches include moving averages, momentum trading, breakout strategies, relative strength indicators, and trend-following systems. The topic highlights that many managed futures and commodity trading advisors (CTAs) employ systematic technical strategies designed to capitalize on persistent price trends across global markets. Technical strategies often benefit during periods of sustained market momentum, but may underperform during volatile, range-bound, or rapidly reversing market conditions, where trends become less predictable and transaction costs increase. Fundamental directional strategies focus on identifying mispriced securities or macroeconomic trends using economic analysis, company valuation, industry research, and financial statement evaluation. Investors employing these strategies analyze factors such as earnings growth, interest rates, inflation, monetary policy, geopolitical conditions, and business cycle dynamics. The program explains that fundamental managers attempt to determine intrinsic value and profit when market prices diverge from estimated fair values. Directional macro strategies frequently involve large positions in equities, fixed income, currencies, and commodities based on expectations regarding economic and policy developments. The topic also discusses the importance of illiquidity premiums, which compensate investors for holding less liquid assets that may generate higher expected returns but expose investors to greater funding and market risks. Behavioral finance plays an important role in directional trading because investor emotions and cognitive biases can create predictable market patterns and temporary mispricings. The program examines how overconfidence, herding behavior, loss aversion, anchoring, and confirmation bias may influence asset prices and trading activity. Trend-following strategies often capitalize on behavioral momentum effects, while contrarian strategies attempt to exploit overreactions and excessive pessimism or optimism. The topic explains that behavioral biases can persist because institutional incentives, career risk, and emotional decision-making prevent markets from immediately correcting inefficiencies. Understanding investor psychology, therefore, enhances directional trading by helping managers anticipate how market participants may react to new information, economic uncertainty, and periods of financial stress. The topic concludes by discussing directional trading implementation and portfolio management considerations. Directional trading involves maintaining intentional exposure to market movements while managing downside risk through diversification, hedging, position sizing, and stop-loss disciplines. Managers may trade across multiple asset classes and geographic regions to capture global macroeconomic trends and reduce concentration risk. The program emphasizes that successful directional investing depends not only on forecasting skill, but also on disciplined execution, liquidity management, and risk control. Because directional strategies are vulnerable to rapid market reversals and changing correlations, continuous monitoring and adaptive portfolio management are essential. Ultimately, directional strategies seek to generate alpha by identifying persistent trends, valuation discrepancies, and behavioral inefficiencies within dynamic global markets.